In 2000, the dot-com bubble burst, erasing trillions in wealth. In 2008, a crisis built on financial instruments nobody truly understood brought the global economy to its knees. Each time we told ourselves we'd learned our lesson. We believed we had built a stronger, smarter system. Today, Wall Street's obsession with artificial intelligence is creating a new bubble. But this time it's different. This time, the crash could be triggered, accelerated, and amplified by the very technology that banks and hedge funds believe will make them invincible. While these firms race to cash in on the promise of godlike predictive power, they're ignoring a terrifying reality. These complex AI systems could trigger a simultaneous automated sell off, a financial crisis that moves faster than any human could ever hope to stop. Imagine waking up to discover that the thing we built to master the market has become its executioner. This isn't some distant sci fi fantasy. The seeds are being planted right now on the servers of the world's biggest financial institutions. They are building the perfect weapon for the next economic meltdown, and they're calling it progress. In this video, we'll uncover the hidden risks, the systemic dangers, and the shocking historical parallels that Wall Street is ignoring. We will expose how the race for profit is creating a doomsday machine at the heart of our global economy. To understand how AI could destroy the market, you first have to get why Wall Street is so captivated by it. The answer is simple: the promise of an unbeatable advantage. In finance, information is power, and speed is everything. A few milliseconds can mean the difference between billions in profit or loss. For decades, firms have been locked in an arms race, building faster algorithms and more powerful computers. AI isn't just the next step in that race, it's a quantum leap. Financial institutions are pouring billions into AI for three main reasons: trading, risk management, and efficiency. Let's start with trading, the most high stakes application. Algorithmic trading, where computers execute trades based on preset rules, is nothing new. But those algorithms are rigid. They only follow the rules they're given. Artificial intelligence, especially machine learning, is different. These systems can learn and adapt on their own. They sift through colossal data sets, market data, geopolitical news, social media chatter, even satellite imagery, to find subtle patterns that are invisible to human analysts. They can predict market moves with shocking precision and execute millions of trades faster than you can blink. Take derivatives trading, one of the most complex corners of finance. AI is revolutionizing it with more accurate pricing models and by optimizing the complex web of collateral requirements. This gives traders a huge edge, flagging warning signs that humans would miss. In portfolio management, AI can constantly adjust asset diversification to maximize returns while minimizing risk. It's why firms like JP Morgan Chase and Goldman Sachs have made AI a core strategic priority, building proprietary systems they hope will let them systematically beat the market. The second siren call of AI is risk management. On the surface, this sounds like a great thing, and in some ways, it is. Artificial intelligence systems can monitor transactions in real time to detect fraud and credit risks far faster than any team of humans. Machine learning can more accurately predict if a borrower will default, potentially preventing the kind of bad debt that crippled the system in 2008. Proponents argue AI can prevent the next crisis by helping firms see threats coming and neutralize them before they become systemic. Finally, there's the relentless drive for efficiency. Artificial intelligence chatbots can handle customer inquiries, and routine paperwork can be automated, freeing up employees for more complex work. For an industry obsessed with the bottom line, the cost savings are immense. This combination of godlike trading, supposedly foolproof risk management, and radical efficiency has created a frantic gold rush. Not adopting AI is seen as a death sentence. Every major bank and hedge fund is racing to integrate it into every part of its business. But in this rush for profit, they're all ignoring a terrifying truth. They are building systems whose complexity they don't truly understand, and that's where the danger begins. The single greatest risk of AI in finance is also its most defining feature: the black box. The term describes a system where you can see the inputs and the outputs, but the process in between is completely opaque, often even to its own creators. This isn't a bug, it's how advanced machine learning works. These systems build their own logic, creating intricate neural networks with millions of parameters. They don't follow human written rules, they create their own. For regulators and even for the banks themselves, this is a nightmare. How do you manage a risk you can't explain? The Federal Reserve has been clear that banks must be able to understand and test the models they use. But with AI, that's becoming nearly impossible. Regulators insist that opacity won't be an excuse, yet the technology's very nature makes full transparency a pipe dream. If a bank uses an AI to deny someone a loan, it's legally required to provide a specific reason. But what if the honest answer is the algorithm decided and we don't know why? This is a looming legal and ethical crisis. The Consumer Financial Protection Bureau has already warned that anti discrimination laws fully apply to AI, no matter how complex the model. The black box problem becomes truly terrifying when you apply it to trading. Imagine a powerful AI model that's been generating consistent profits for months. Its developers trust it, the firm trusts it, they pour more and more money into its strategies. But one day, faced with a set of market conditions it has never seen before, a weird mix of a political scandal, an odd inflation report, and a solar flare disrupting satellite data, the AI behaves in a completely unforeseen way. It might start dumping assets at a speed and scale that seems irrational because its internal, inscrutable logic has found a pattern it interprets as catastrophic. The human overseers are left staring at their screens, powerless because they can't understand the AI's reasoning. They have to choose trust the black box or pull the plug and risk missing a massive, legitimate market shift. This leads to another problem known as model drift. An AI isn't static, it's constantly learning from new data. Over time, its logic can drift away from its original programming into unpredictable territory. It's like a pilot who has flown 1,000 flights perfectly, but over time subtly forgets how to handle turbulence. You won't know there's a problem until the plane is already shaking apart. Financial institutions have playbooks for risk, but how do you write a playbook for a system that writes its own rules? The risk is no longer just a bug in the code, it's about the emergent, unpredictable intelligence of the system itself. And if a model makes a catastrophic mistake, who is accountable? The programmer, the institution that deployed a system it couldn't explain? The allure of AI is the promise of total control. But what Wall Street is actually building is an illusion of control. They are ceding authority to algorithms whose decisions are fundamentally unknowable. They're flying blind, convinced that because the black box has worked so far, it will work forever. If one black box AI going rogue is a problem, what happens when thousands of them start acting in unison? This is the threat of AI driven herding, and it could trigger a flash crash so fast and deep it would make the 2010 event look like a minor glitch. Herding in markets isn't new. It's when investors follow the actions of a larger group, selling when everyone else sells, often out of fear. But AI adds a terrifying new dimension: automated, synchronized, and lightning fast herding. Here's how it could happen. The financial world is becoming more and more reliant on just a few data providers and foundational AI models. Instead of building their systems from scratch, many firms use similar open source models or buy solutions from a handful of dominant tech vendors. This creates what regulators call a monoculture. These different AIs, run by competing firms, are being trained on similar data with similar goals. As a result, they're likely to develop similar logic. They learn to spot the same signals, interpret them the same way, and react with the same strategies. Now imagine a minor but unusual market event. It could be anything: a weird manufacturing number from a mid sized economy, a data breach, or even AI generated fake news that fools the algorithms. One AI, let's call it AI Alpha, spots this anomaly. Its black box logic, trained on data that shows similar patterns preceding downturns, initiates a large sell order. Instantly, other AIs see the effect of this sale. AI beta at a competing firm isn't just watching the news, it's watching the market itself. It sees a sudden, large sell off, and its own logic, eerily similar to Alpha's, concludes that something is wrong. It also starts selling. Then AI Gamma and Delta join in. Within milliseconds, a cascade begins. It's an echo chamber of algorithms, each one reinforcing the other's decision. This isn't a slow motion panic on a trading floor, it's a synchronized digital wave of sell orders executing at the speed of light. The 2010 flash crash, which temporarily wiped out nearly $1 trillion in market value, was caused by a feedback loop between simple algorithms. What we're talking about now is orders of magnitude more dangerous. These are learning, adapting intelligences capable of executing far more complex strategies at an even greater scale. The European Central Bank has explicitly warned that this convergence of AI strategies could distort asset prices and foster herding behavior. The Bank of England has raised similar alarms, noting that widespread use of just a few vendor models could create a system-wide vulnerability. An event that once caused a minor dip could be amplified by algorithmic herding into a full-blown crash. And the scariest part? Humans would be virtually powerless to stop it. By the time regulators even realize what's happening, the damage will be done. The market circuit breakers might trigger, but they are a blunt instrument designed for a human speed world. In an AI driven panic, the contagion could spread across global markets before anyone in charge has had time to figure out what's going on. In the pursuit of an algorithmic edge, Wall Street is paradoxically creating a market where everyone's digital proxies think alike. They're building a global echo chamber where a single whisper can be amplified into a deafening automated roar. Every complex system has a weak point. In the AI driven financial world, that weakness is becoming dangerously concentrated in one company, NVIDIA. The entire AI revolution is built on its specialized graphics processing units, or GPUs. This has turned NVIDIA into a behemoth, crossing a staggering $5 trillion market capitalization in late 2025. But it has also made the global economy terrifyingly dependent on its success. This dependency is amplified by a phenomenon that looks a lot like a bubble: circular investments. Here's how it works. Giant tech companies and venture capital funds pour money into promising AI startups. Those startups, now valued in the billions, turn around and use that capital to buy the essential hardware they need. NVIDIA's GPUs. It's a self reinforcing loop. Money flows out of the tech ecosystem to a startup and then flows right back to NVIDIA as sales. This inflates NVIDIA's revenue, pushes its stock price higher, and gives it more capital and a higher valuation to fuel the cycle. It creates the appearance of a booming market, but a big part of the demand is artificial, funded by the ecosystem itself. This dynamic has led to extreme market concentration. By late 2025, the five largest tech companies made up nearly a third of the S&P 500, the greatest concentration in half a century. Valuations are stretched to levels not seen since the dot-com bubble. This creates an incredibly fragile house of cards. The entire system rests on the idea that NVIDIA's dominance is permanent. But what if it isn't? The risks are huge. First, geopolitical risk. NVIDIA doesn't make its own advanced chips. They're made by a single company, TSMC, mostly in Taiwan. Any conflict in that region could instantly halt the production of the world's most critical AI hardware. Second, concentration risk. NVIDIA's revenue is concentrated among just a handful of customers. As of 2025, a few giant tech companies account for a massive portion of its sales. If one or two of these hyperscalers slow their spending or pivot to their own in-house chips, NVIDIA's growth story could evaporate overnight. Third, competitive risk. NVIDIA's enormous profit margins are a giant target for competitors. AMD, Intel, and a host of startups are scrambling to create rival chips. At the same time, NVIDIA's biggest customers, like Google, Amazon, and Microsoft, are all developing their own custom AI accelerators. Finally, there's the simple risk of disappointment. Valuations are currently pricing in perfection. But what if the AI productivity revolution doesn't happen as fast as hoped? A 2025 MIT report titled The Gen AI Divide found that despite tens of billions in investment, 95% of organizations studied were getting zero measurable return from their generative AI initiatives. If enterprise demand stumbles, the justification for these sky high valuations disappears. Any of these factors could prick the bubble, and because NVIDIA isn't just another tech stock, it's the foundation of the entire AI narrative, its collapse wouldn't be contained. It would trigger a crisis of confidence across the entire market. The single point of failure would become the single point of collapse. Those who don't learn from history are doomed to repeat it. And right now, history is screaming a warning that is being willfully ignored. The current AI frenzy isn't just rhyming with past bubbles, it's mirroring their most dangerous elements with chilling precision. To see the future of this AI boom, we just need to look at the dot-com bust of 2000 and the global financial crisis of 2008. The dot-com parallel is obvious. In the late 90s, the world was gripped by a new technology, the internet. A euphoric belief in a new paradigm took hold, where old metrics like profits no longer mattered. Today, we see the same dynamic with AI. As former IMF executive Geeta Gopinath has warned, the current rally fueled by AI euphoria is disconnected from economic fundamentals and could be setting the stage for a painful correction. But the more terrifying parallel is 2008. That crisis wasn't caused by simple irrationality. It was caused by financial innovation that was fundamentally misunderstood. The weapons of mass destruction were complex, opaque instruments called collateralized debt obligations, or CDOs. Banks would bundle thousands of mortgages, good and bad, into a new security. Rating agencies, using their own complex models, stamped these bundles with AAA ratings, the highest mark of safety. It was a financial black box. Everyone assumed the models were correct and the risk was being safely managed. This is exactly the role AI is playing today. Artificial intelligence models are the new CDOS. They are the complex, opaque tools that promise to revolutionize risk management. Banks believe these systems give them a clearer view of risk than ever before. But just like the models used to rate CDOs, these AI systems are black boxes. Their inner workings are inscrutable. In 2008, the fatal assumption was that housing prices would never fall on a national level. When they did, the models broke. The safe securities turned out to be toxic. The risk that was supposed to have been diversified away was actually just hidden and concentrated. Because these instruments were so interconnected, one failure triggered a catastrophic domino effect. Today, the AI models used for trading and risk are trained on historical data. But what happens when they face a truly novel black swan event that isn't in their training data? Their performance could degrade in unpredictable ways. An AI system designed to manage risk could, in a crisis, start amplifying it, just like the CDOS did. Gita Gopinath has warned of this exact scenario, cautioning that AI models could fail when faced with novel events, potentially causing a self-confirming spiral of fire sales and collapsing asset prices. The fatal flaw in 2008 was a blind faith in complex models that promised to eliminate risk, while actually creating a new, hidden, systemic form of it. Today, we're making the exact same mistake. We are placing our faith in AI black boxes, believing they will make the financial system safer when they may be the very things that cause it to collapse. A financial crash triggered by AI wouldn't just be Wall Street's problem. The fallout would cascade through every level of society, creating a recession that is not only deep, but fundamentally different. The very tool that caused the crisis, AI, would then be used to amplify its brutal consequences for ordinary people. The most immediate impact would be mass unemployment. In any recession, companies cut costs, and labor is the biggest expense. But in an AI-driven recession, the logic of automation becomes inescapable. During good times, firms invest in new tech. During downturns, they use that tech to replace human workers. Research highlighted by the IMF's Gita Gopinath shows a stark pattern. Nearly 90% of automation-related job losses in the US have historically occurred in the first year of a recession. This was clear during the 2008 crisis, which led to a jobless recovery as companies accelerated automation. The next time, it will be worse. The jobs at risk are no longer just routine manufacturing tasks. Thanks to generative AI, high-skilled cognitive roles are now vulnerable. Analysts, accountants, writers, and paralegals. Gopinath warns that in advanced economies, as many as 30% of jobs are at high risk of displacement by AI. A crash would give companies the perfect excuse to slash their human workforces and replace them with cheaper, more efficient AI. This would, in turn, dramatically worsen wealth inequality. A market crash always hits ordinary people's retirement savings the hardest. But an AI-fueled crash would be particularly skewed. The wealth of many households has been inflated by the AI stock boom. When that bubble bursts, it will be their life savings that evaporate. Meanwhile, the architects of the system, the hedge funds that deployed the trading AIs and the tech executives, could walk away with staggering profits. The result would be a massive transfer of wealth from the middle class to a tiny elite, creating huge social and political instability. Finally, an AI-triggered crash would lead to a profound loss of trust. Trust in financial institutions, which never fully recovered from 2008, would be shattered. But this time, the crisis of confidence would extend to technology itself. If the systems we built to be smarter than us prove to be just as reckless, how can we ever trust them again? An AI crash would be a fundamental failure of fairness, transparency, and accountability. This could lead to a popular backlash against technological progress, hampering innovation for decades. The crash might be measured in dollars, but the true cost would be measured in lost jobs, shattered lives, and a broken social contract. Before we get to the final section, where we'll paint a picture of exactly how this crash could unfold, a quick request. This kind of deep dive analysis takes a huge amount of research. If you're finding this video valuable, please hit the like button and subscribe. It tells the algorithm that people care about this topic and allows us to keep making content that challenges the mainstream narrative. Your support is what makes this work possible. Now let's look at the timeline of the inevitable crash. So, how does it all come together? Let's walk through a plausible, speculative timeline of how the crash could unfold. It won't begin with a deafening explosion, but with a quiet, almost imperceptible tremor. Phase 1, the trigger, T minus 60 seconds. The event that starts it all is insignificant on its own. It's a report of a fire at a minor but critical semiconductor plant. The news is real, but its immediate market impact should be minimal. However, dozens of major AI trading models, all trained on the importance of the semiconductor supply chain, pick up the news simultaneously. Their opaque logic connects this event to a low probability scenario of a wider supply chain disruption. It's a correlation no human analyst would make so quickly. One of these models, managing a multi-billion-dollar portfolio, makes the first move. It sells a basket of tech stocks, including a modest position in NVIDIA to reduce exposure. The entire process takes less than 500 milliseconds. Phase 2, the cascade, T minus 30 seconds. That initial sale is a massive signal in the world of algorithms. Hundreds of other AIs, which constantly monitor market order flow, detect the sudden sell pressure. They don't know the why, they only see the what. Their herding instinct kicks in. Their logic says a large, fast sell off from a sophisticated player must be based on information they don't have. They begin to sell the same stocks. This is where the echo chamber takes hold. The selling from the second wave of AIs triggers a third and fourth. Each new sell order validates the initial decision, creating a feedback loop of escalating panic. The selling quickly coalesces around the market's single point of failure, NVIDIA. The stock, seen by the algorithms as a proxy for the entire tech ecosystem's health, begins to drop sharply. Phase 3, the flash crash, T minus 10 seconds. NVIDIA's plunge acts as a system-wide catalyst. Automated risk management systems at banks and investment funds, both AI driven and traditional, are triggered. Their rules dictate that if a core holding like Nvidia drops by a certain percentage, they must sell across their entire portfolio. This unleashes a tidal wave of automated sell orders across the entire market. It's no longer just tech stocks. Everything is being sold. The Dow, the S&P 500, and the Nasdaq all go into a nosedive, dropping several percentage points in seconds. The speed is unlike anything ever witnessed. Human traders are just staring at their screens, a waterfall of red, completely unable to process the speed of the collapse. Phase 4, global contagion and system failure, T equals 0. The first circuit breaker trips, halting trading on the New York Stock Exchange for 15 minutes. But it's too late. The panic has gone global. Artificial intelligence trading systems in London, Frankfurt, and Tokyo, programmed with the same herding instincts, have already reacted. They begin selling off their own markets. During the 15-minute halt, chaos reigns. Regulators and central bankers are in emergency meetings, but they are flying blind. They don't know what caused the crash. Was it a cyber attack? A major geopolitical event? They can't find a root cause because it's buried in the inscrutable logic of 1,000 black boxes that all decided to panic at once. When the market reopens, the selling continues, now fueled by human panic. The financial system, the intricate web of trust that powers the global economy, grinds to a halt. The crash is no longer a technical anomaly. It is a full-blown economic heart attack. What we've just outlined is not an outlandish fantasy. It is a logical extrapolation of the path we are currently on. We've detailed the allure of AI on Wall Street, exposed the flaw of the black box, and explored how this creates the perfect conditions for automated herding. We've shown how the entire edifice is being built on a fragile single point of failure, dangerously concentrating risk. And we've seen how this all echoes the hubris of past financial crises. The race to implement AI in finance is creating a new class of risk that is faster, more complex, and more interconnected than anything our regulatory systems are designed to handle. Former IMF executive Geeta Gopinath puts it starkly, warning that a market correction similar to the dot-com crash could now wipe out a staggering $35 trillion in global wealth, $20 trillion from US households, and another $15 trillion from foreign investors. This is not an argument against artificial intelligence. The technology holds immense promise, but innovation without wisdom is a recipe for disaster. We are handing the keys to our global economic engine to systems we do not understand and cannot control, all for short-term profit. So, what can be done? We need a radical push for explainable AI, demanding that firms cannot deploy models whose decisions can't be audited. We need robust regulation that keeps pace with technology, not one that is constantly years behind. And it requires building in meaningful human oversight, not as a token gesture, but as a fundamental fail-safe. As Gita Gopinath consistently argues, while the benefits of AI are real, the risks are just as real. The question is not if AI will change the world, but how we will shape that change. If we fail, the same technology we hail as our greatest creation could amplify the next downturn into something more damaging than we can imagine. The choice is still ours. We can continue down this path of blind faith, building our own digital doomsday machine. Or we can pause, demand transparency, and build the guardrails needed to ensure that artificial intelligence serves humanity, not becomes its greatest economic threat. The clock is ticking. Thank you for watching. This is a complex topic, and I want to hear your thoughts. What do you believe is the biggest risk that AI poses to our financial system? Do you think the benefits outweigh the dangers? Let me know in the comments below. And if you haven't already, please subscribe and turn on notifications so you don't miss our next investigation.